So, a quick question before we even say hello. Did you see the news this past week that prices are actually coming down? Finally coming down. Walmart, like one of many grocery stores, announced price cuts. In Walmart's case, they announced a price cut on beef and corn and cherries and chips and Coca-Cola. And the headline is calling it a big win for shoppers. So here's my question for you. If prices are dropping, why did your receipt last week say otherwise? Stick with me, because by the end of this episode, I'm going to show you exactly why that headline is misleading, who's really controlling what you pay at the register, and what one client of mine did that put her $3.5 million ahead of where a typical retirement plan would have left her. And I promise you, by the time we get there, you're going to look at your grocery bill completely differently. Now, let's get into it. I'm Mike Adams with Adams Financial Concepts, where we focus on one thing: creating and protecting wealth for clients and for people who want a real retirement, not a guessing game. So let's start with the headline. Walmart is cutting prices. They're cutting the price on a pound of ground beef. It went from $6.74 to $5.94. That's great. But here's what they didn't put in the headline. There are 40,000 other products in that store. And that one discounted, one item, it's not a gift, it's a bait. It's designed to get you in the door so you fill your cart with everything around it, the stuff that's not for sale. Think about the last time you went in for just one thing into the grocery store and walked out with a full cart. It's not an accident. That's the entire business model of a grocery store. The loss leader gets you through the door. The other 39,999 items pay the bills. It's not a discount. It's a strategy. And the fact that stores need to bait you right now, the fact that they're competing this hard for your dollar, that tells you something important about where things really stand economically. The Conference Board just released their May 2026 Consumer Confidence Study. And here's where the numbers stood out. 66% of households, 2 out of every 3 people listening to this right now, 2 out of every 3 Americans say they actually are cutting back their spending because of inflation and rising fuel costs. Sit with that for a second. 2 out of 3 households. That's not a fringe group feeling the pinch. That's a majority of the Americans. Grocery stores can seem to happen in real time. Customers are skipping their high margin items. They're buying the store brand instead of the name brand. They're skipping the second case of soda. So the stores panic a little and they roll out discounts, all designed to lure you back in and hope you fill the cart with profitable stuff while you're there. There's an old saying that explains exactly what's happening in the economy right now. Prices go up like a rocket. They come down like a feather. Everybody nods along when they hear that. It sounds true, but I want to actually explain why it's true, because once you understand the mechanism, you'll never look at a sales sign the same way again. Companies raise prices the second they get a reason to. Tariffs get announced, prices go up that week. Farm labor shortages hit because of immigration enforcement, prices go up again. Costs go up, prices go up, almost instantly. That's the rocket. But bringing prices back down, that's supposed to happen through competition. Companies fighting for your business until prices settle down to where they should be. The feather. The problem is in the grocery supply chain, there isn't much competition left to do the job. Let me give you some numbers, because this is the part that most people have no idea about. 4 companies control 85% of the beef market. 80% is controlled by 4 companies For the soy market, 3 companies control 78% of the pasta market. 3 companies control 72% of the cereal market. 4 companies control up to 85% of the urban chicken market. And 4 companies control 63% of domestic wheat milling. Read that again. Beef, soy, pasta, cereal, chicken, wheat, the actual staples that fill your cart every single week. And every one of those categories, 3 or 4 companies control the vast majority of the supply chain. That's not competition. When a market's controlled by 3 or 4 players, it's not really a market anymore in the way we learned about it in school. It's closer to a handful of gatekeepers who can quietly agree, without ever picking up a phone, that nobody needs to drop prices very far or very fast. And here's where it gets even more interesting. Back in 2021, there was a federal executive order 14036, that empowered agencies, government agencies, to actually crack down on this kind of consolidation. It forced the USDA and other agencies to write strict new rules under something called the Packers and Stockyards Act, specifically designed to stop massive meat corporations from squeezing small, independent family farms. That order got rescinded last year, and when it did, a couple of specific protections started unwinding. Number 1, what was called the tournament system rule, unwound, was designed to make sure that chicken farmers actually got paid fairly and weren't forced into expensive, unexpected barn upgrades by the processors. That got delayed. The second thing that happened is the anti-retaliation protections were removed. It stopped big meat companies from punishing farmers who spoke out about bad corporate behavior. Those are facing a full rollback. So think about what that means in practice. The companies that control the process and just don't package your food under different brand names on the shelf, they can effectively dictate to farmers what to raise and what they'll pay for it. And the referee that was supposed to make sure that relations stayed fair, that referee got sent home. That's the actual mechanism between or behind prices go up like a rocket and come down like a feather. It's not supposed to be a mystery. It's not bad luck. It's structural. So here's the real question that I really want you sitting with, and hold on to this because I'm going to come back to it. If grocery bills keep climbing like this year after year, what happens to your retirement if this becomes permanent, new normal? Not a temporary spike, but a permanent new normal of prices increasing every week. Hold that thought. I'm going to answer it directly with a real story in just a few minutes. But first, if what I just described sounds familiar, and if you noticed your money's not stretching the way it used to, and if you're wondering whether your current plan can actually hold up against this kind of pressure for the next 10 or 15 or 20 years, it's exactly the conversation I have with clients whenever we meet. I offer a complimentary retirement review where we sit down and look exactly where you stand if you're not a client and figure out if your plan is built for what's actually happening in the economy. Not what a generic formula says, not what a computer program spits out, but what really happens. And you'll find the link in the notes. So if you want to grab a time right now, click on that link and let's talk. But stick around because the story I promised you is exactly why this matters, and I think you're going to want to hear it before you do anything else. So let's go back to that question. What happens to your retirement if grocery bills and fuel and insurance and medical costs and transportation costs, if they just keep climbing and climbing and climbing? And I want to answer that with a real client of mine, a real name. With her permission, her story is the best answer I have. Let me tell you about my client, Alma. In early 2011, Alma came to me with 3 accounts: an individual account, an IRA, and a Roth. She put away about $500,000. She was self-employed. She had just reached retirement age, and she'd bought a condo in a neighborhood close to her daughter. On paper, you'd think she was set. She wasn't. Even withdrawing 6% from those accounts, plus Social Security, she didn't have enough income to even retire, to keep the quality of life she wanted. She told me flat out she figured she'd be working the rest of her life, not because she wanted to, but because the math didn't work any other way. But here's what happened instead. Over the next 7 years, through the end of 2018, Alma took an income of over $200,000 out of those accounts. And here's the part that surprises people. The accounts didn't just survive that, they grew. They grew enough that she was able to pay off the mortgage on her condo completely. She now owns it free and clear. By 2019, her accounts were worth over $1.1 million. And she made the decision to wind down her practice and retire. She asked me if she could, and I said, yes, you can. Then right before she officially retired, she sent me an email. She sent me an email. She said her account told me that she owed $50,000 in taxes. She was in a full panic. She said, how is it even possible? I never made $50,000 in income in my life. I looked at her accounts. I looked at what was going on, and I said, Alma, it's correct. I had sold a stock position in her account, and it generated a significant capital gain. Since that gain happened inside her account, I said, we should pay the tax straight out of that same account. And I told her something else too. Gains like this were probably going to keep happening as the account grew. And I concluded by saying, welcome to being a millionaire. She officially retired on July 1st, 2020. Today, her account sit at over $3.5 million, even after withdrawing over $700,000 total along the way. And I want to be clear about something. This wasn't an aggressive swing for the fences type portfolio. It was a fairly moderate risk. That's it. Fully invested since 2011. She rode through the 2022 downturn. She rode through the pandemic just the same as everyone else. No secret formula. No exotic investments. And here's the part that should stop you right now and in tracks. Most financial advisors run your numbers through a computer. They plug in your assets. They hand you a safe withdrawal number based on industry averages. There's research, a study from SEI, studies from Goldman, studies from other companies as well, showing the typical financial advisor delivers around 5%, and the typical withdrawal rate of 4%, 4% is even too high. For Alma with her 500,000, that 4% number works out to about $2,000 a month. Do the math for me for a second. $2,000 a month plus Social Security. Would that have allowed her to retire, pay off her condo, and travel? No. Should almost certainly be still working today, still making condo payments, still wondering if she would ever get to stop. Instead, almost fully retired. She's mortgage free. She now gets to spend her winters in Puerto Rico. And on a personal note, she's developed a relationship with her daughter's friend's 2 daughters, and she's become an adopted grandmother. That's not a financial detail. It's the kind of life that becomes possible when the financial side isn't a constant source of stress. Now, here's what I want you to actually picture something with me. Picture today, Alma, instead of where she was. Imagine she had that original 500,000 growing at a modest 5%. And she was facing today's grocery prices, today's inflation cost, medical cost, transportation cost. Picture her Social Security check coming and trying to stretch all that. That's not a retirement. That's a triage. That's deciding which prescription she can afford to fill this month and which one has to wait. That's putting the cheaper cut of meat back and grabbing the loss leader instead, hoping it's enough. That's not the story she's living. And it doesn't have to be the story that you live either. Here's what's different in Alma's case. It wasn't luck. Most retirement plans are built around a static rule, the 4% rule or something close to it. It's applied the same way to every single client, regardless of their actual life, their actual goals, their actual flexibility. It's a spreadsheet answer. It's a computer answer to a human question. The approach I use is different. It's dynamic. It adjusts. It builds a steady stream of income. When markets are strong, we can be more flexible. When markets pull back, like they did in 2022, we adjust rather than blindly sticking to a fixed number that could deplete the account too fast. And critically, we plan for things like capital gains events before they surprise you, not after. That's the entire difference between a client who's still working at 75 and a client who's spending winters in Puerto Rico. I want you to do something right now, if you're listening. Think about your own retirement numbers. Whatever you've got saved, whatever's sitting in your 401k, your IRA, your investment account. Now imagine someone telling you, here's your safe withdrawal number, and it's based on industry average spreadsheet formula, based on historical inflation rates, based on historical returns of stocks and bonds and annuities and whatever else, based not on your specific goals, but what the computer spits out. Does it feel like enough? Whatever you think you need right now, your computer plan says, you should be able to triple that and look at those numbers. For most people I talk to, the honest answer is they don't actually know. Nobody's ever walked them through it the way that made sense for the real life. That's the gap that I'm talking about now. The headline says grocery store prices are going down. Fuel prices, Mesa, are going down. What's actually happening is a handful of companies controlling the vast majority of your food supply are tossing out a few loss leader discounts to keep you through the door, while the structural forces driving up the real cost of living, consolidation, inflation, rollback of farmer protections, they aren't going anywhere. The question isn't whether prices will settle down next quarter or next year. The real question you should be asking, is your retirement plan built to withstand this? Is your current retirement built to withstand prices, whether they settle down or not? Alma's plan was built specifically around her, not an average. That's the entire difference. I told you at the start of the episode, I'd show you what one client did that put her millions of dollars ahead of a typical plan. You just heard it. Now let's talk about what I want you to do with that. Here's what I want you to do right now, not later, not when things settle down, not after the holidays, but right now. While this is fresh in your mind, pick up your phone, open your email, reach out to my office at Adams Financial Concepts to schedule a complimentary retirement review. I know some of what you're thinking. I don't have $1 million like Alma did. This isn't for me. It's exactly backwards. Alma started with 500,000. We have clients that started with even less. We have clients that started with significantly more. The whole point of this conversation is that where she ended up wasn't about the size that she started with. It was having a plan. It was having a plan built around a real life instead of a generic formula. That applies whether you're starting with 50,000 or 500,000. I know some of you are thinking, I'll do it later. Things aren't really that bad. I'd ask you this. How many households did we say we're cutting back on spending? 2 out of every 3. The pressure's already here. Even if you're not cutting back on spending, I believe that you're like we are, and we're fortunate that we're able to afford this. We just complain about the prices and pay anyway. But remember, prices are increasing and probably going to continue to increase next week and next month and next year and the year after that and the year after that and the year after that. People who end up like Alma, fully retired, mortgage paid off, wintering whether they want, not worrying about grocery prices. They didn't get there by waiting for the economy to get easier for the right time to show up. There's no perfect time. They got there by making the phone call, by sitting down with someone who was able to build a plan for them. A real plan, not a computer-driven plan, but a real plan that looks at how to get to where they want to be. Don't wait. Grab a time on the calendar. Become a person who wants to know how you can survive and thrive during this period of time. Schedule a time now, and we do that even as we come to an end.